So what we have here is, let's just talk about this for a second. Let's say we've got this network. Let's say it's worth $10 million, and you want to build that network. So one alternative as a government is you go, in our case as a government entity, you go to TCV, the government borrowing agency, and you borrow the money. You borrow the $10 million. So it would appear reasonable that in the cost of this service, you should get paid the interest cost of that borrowing the $10 million. That is reasonable, so I think that's an argument that in the building block there's a cost of any interest payment. And if you borrow 100%, then you should get the 100% of the interest. Now, then you move to, well, what happens if the government has actually got the cash, and it's giving you the cash in terms of equity, and you use it through equity, and to make it simple, ESC regulation assumes that 60% of the business is financed through debt and 40% through equity. So let's say we do that. Well, does that mean because it was cash in the bank that you shouldn't actually get a return on it? Doesn't seem to make sense. That you'd actually have a price difference because one you borrowed and two you financed through cash in the bank, and therefore you have a different price. So it would seem that you should at least get a return equal to the debt, regardless of whether it's equity or debt. And then, of course, you've got, in terms of weighted average cost of capital, we all know that there's a higher cost of equity than debt. So should you get that higher cost of equity? And I think this is where people start to get into they shouldn't pay a dividend. Well, as a government-owned business, where does that equity come from? It essentially comes from the taxpayers. The government have raised taxes and they've spent it on some services, and if they've got spare cash, it's come from us. And so, as a taxpayer, indirectly, should I get a return on that investment? Well, I would think so. Because if they didn't take it off me, then I could invest it in, if I wanted to pick the same industry, I could invest it in Anglian Water, or I could invest it in AGL, an electricity industry. So, regardless of whether it's government source of funds or private source of funds, there should be a return on investment. So maybe this person agrees that it's appropriate to put it in the building block, but should they just keep the money in the company and not pay it out? Well, I don't know what their view is here, and I don't understand it, because if you keep it in the company, it doesn't mean the price is any lower, because the regulator's given you a price based on the weighted average cost of capital is 60 and it's 60-40, and if you've got 100% cash, they're not going to give you any more or any less. So they're sitting there holding on to this money, not returning to the investors, who will either lower the taxes or spend it on school, roads, hospitals, or whatever. But I'm not sure why people think they should hold on to that cash. There's no great value for their own customers of them holding on to the cash, and they're obviously depriving the investor. Because in the end, if the money does go back appropriately to the government, well, they might lower taxes, which they had in boom times, or they might spend it on other services. So I find it quite disturbing that people think that a legitimate cost is not a return on that investment, simply because we're government.